Hello students, let's talk about the accounts receivable allowance method to estimate uncollectible accounts receivable. We cannot guarantee that 100% accounts receivable can be collected if we have like millions of customers on credit transactions. So we have to set up some estimation provision of uncollectible accounts receivable if we have the past information of the collection, the data. So we have three different approaches of estimating the uncollectible accounts receivable. First, the percentage of sales method through the income statement approach and percentage of accounts receivable and aging receivable also the balance sheet approach. It's kind of the percentage of accounts receivable as well. First, the percentage of sales method. Example, ABC Corporation basis the estimated uncollectible accounts on total credit sales for the period. ABC estimates that 2% of its 200,000 sales on credit. So that is income statement approach because we are using the sales amount to estimate allowance for bad debt, allowance for uncollectible account, which is the same. Will not be collected. So the credit balance in the allowance for uncollectible accounts before adjustment is 1,000. So we have beginning balance of allowance for bad debt, allowance for uncollectible account. So again, it's the same allowance for bad debt. So the generalized allowance account, okay, the sales 200,000 on credit. Now on the debit, we increase cash to receive, accounts receivable, and sales. The credit sales the same value, 200,000, but we have information, the balance sheet and income statement, all the financial statement and reporting procedure should be realistic, relevant. So the adjustment we required, allowance for bad debt 2%. Now, why don't you just put the sales and then 2% times 200 so that we can reduce the sales? No, we cannot. Or accounts receivable, the same 2% of accounts receivable because 2% is not going to be collected. But we cannot. Why? Because this 2% of provision is just estimation. We estimate 2%. I know we have past information of 2% has not been collected based on the past information data. But we cannot guarantee that this 2% of sales will not be collected for sure because it is estimation. So inevitably, we have to use some contra account or negative account that reduce this main account. First, to reduce the sales, we should use the bad debt expense. So bad debt expense. Instead of AR directly written down, we should use, yes, we already have here, allowance for bad debt, so that we can reduce the main account, the sales and accounts receivable, until this 2% or 1% is determined not collected. So we put AR 200,000 and sales 200,000 and allowance for bad debt, which is negative contra account that reduce the AR value. So and the bad debt expense also the expense, the negative account that reduce the sales. So we got it. By doing so, AR net value is reduced like that way. Okay. What about the percentage of accounts receivable? Now we have different approach. We set up the allowance for bad debt, allowance for uncollectible accounts from the balance sheet information. So, example, DF Corporation use percentage of for uncollectible accounts based on the year-end balance in accounts receivable. So this company estimates that the balance in the allowance account must be 2% of ending balance of accounts receivable, $80,000. So let's put $80,000 accounts receivable, that is ending balance. Unlike this percentage of the sales method, we use accounts receivable on the balance. That's why we say this approach is balance sheet approach. And then we set up allowance for bad debt at the end of the year based on the ending balance of accounts receivable. But the percentage of the sales method, we keep updating. This sales whenever the credit sales incurs, right? So those are the difference. We are using sales on the percentage of the sales method, or accounts receivable, percentage of accounts receivable on the balance sheet. So here, allowance for bad debt, we have 1,000 credit before adjustment. So we have a beginning balance. There we go. Oh, I missed here 1,000 before adjustment as well. Like that, 1,000 minus. Okay, like that way. Good. The same way, we have allowance for bad debt. The beginning balance, $1,000 credit before adjustment. We already have the allowance, the account already 1,000 here. Then ending balance of accounts for bad debt required. That is ending balance allowance for bad debt required. How do we calculate? There we go. 80 times now 2%. So 1,600 is ending balance, but we have the 1,000 allowance for bad debt from the beginning balance. The balance in the allowance account is 1,000 credit before adjustment. So what balance allowance for bad debt do we need? Do we need more? We should have allowance for bad debt ending balance 1,600, but we have only 1,000. Okay, let me show you in this way. So we need 600 more. So we should adjust allowance for bad debt increase on the contra account of accounts receivable 600, and on the debit side, bad debt expense on the income statement, so 600. By doing so, we can increase the 600 contra account of AR, allowance for bad debt. Now we made up. So the ending balance should be the 2% of AR, 1,600, exactly same. We have had 1,000 on the beginning balance of allowance account, but we need 600 allowance for bad debt, the more, right? So we also record this bad debt expense 600. So that approach is a little bit different, backward. We're starting from the allowance of bad debt. We set up this allowance of bad debt from the accounts receivable, percentage of accounts receivable. But this percentage of sales, we are using the sales amount to set up this the bad debt expense and allowance of bad debt. That is the difference. Now, aging receivable method, also a kind of percentage of accounts receivable, but we are classifying some the AR aging account by some different range of the days. like current or 1 or 2 months or 2 months or 3 months and over 3 months. If the AR has those kind of aging information, and then we have AR balance in each category, and also we also have some specific the data of estimated uncollectible percentage based on the past behavior of collection. So we can calculate the AR, and we can calculate the estimated uncollectible amount more specifically. Okay, here the AR balance in each category we can sum up. So the total balance of AR 25,000 and estimate amount 10,000, and the current balance of AR times estimated uncollectible amount 100. So $100, we assume that we expect that it's not going to be collected. So in the same way, let's drag down. So we got each amount of estimated uncollectible account on each classification by due date. So let's sum up. And 1,240 is the allowance for bad debt. So let's put bad debt expense 1,240. So allowance for bad debt also 1,240. So we got this information. So now AR balance is 25,000 and allowance for bad debt is 1,240, and bad debt expense we record also on the income statement. So that's it. See you in the next video clip. Bye bye.